Good morning and good evening. Welcome to the Market Mondays webinar. My name is Carl Rotter, Senior Market Analyst at Capital.com, and I'm with Danny Haythorne, who's also Senior Market Analyst at Capital.com with me. Good morning, Danny. How's it going?
Good morning, Carl. Good morning, everyone. All good. Another week to look ahead, and it was definitely an interesting end to last week on Friday. So I guess let's just get straight into it, right?
Yeah, no, it should be a fairly fun conversation. It was an interesting thing to wake up to, obviously, in my part of the world on Saturday morning to see things finally having moved after perhaps talking for a little while that we're due a little bit of a pullback. But before we get into the more substantial things, we have to obviously go through the risk warning, and I'll start by just saying that everything that you hear here is of general nature only and doesn't take into consideration anybody's personal circumstances. So make sure that you do your own research and seek out your own advice from an advisor before trading CFDs, of course. And Danny, you've got something to add to that too.
Yeah, just be aware when you are trading with Capital.com's products, so CFDs, and for those of you in the UK, also spread bets. Just be aware that they are high risk products, that they do carry a high degree of leverage and risk. So just be aware of these risks before you trade them, and that they are okay for your own personal circumstances.
Indeed. Okay, well, let's get cracking with what we'll cover. We'll just fly through this very briefly, but obviously, the news to begin with is related to US and China trade tensions and the volatility that has set off. Perhaps you could say that to start the week, the market's looking for a quick taco turnarounds, just with some of the the tone of President Trump's language on Truth Social in the last 24 hours or so, give or take. But there was other things going on as well, and we'll talk about obviously just what's expected in terms of or what's being priced in as far as US rate expectations and also US earnings season, which kind of picks up this week as well with the banks reporting results or starting to report results. But Danny, I don't know if you want to run with it, but obviously we've got this volatility. Effectively, it took a little while perhaps to sink in. The
Yep.
threat to curb rare earth exports came through at about Wednesday, I think, from the Chinese, maybe Thursday. And the reason why
Yeah.
I was reasonably quick on it was that we've got a lot of rare earth stocks in Australia and they were up on the day because of that headline. But the real developments were on Friday night. Perhaps you can run with a blow by blow of what happened.
Yeah, I believe it was on Thursday that China announced kind of a new restriction on sales of rare earth minerals, which of course are those used in advanced chips and basically all of the chips that are used nowadays with AI and the technology. So the news did come out on Thursday. We didn't really see much follow through in markets, and it wasn't until Friday afternoon here in Europe. It was towards the end of the European session. In fact, I had noted throughout the morning that, markets were pretty calm. They were stabilizing a little bit. We'd seen a bit of a sell-off in Europe related to other news, of course, all of the political news in Europe throughout last week. But the S&P 500 towards the open in the US was kind of looking flat on the week. So basically suggesting that even though we had seen a bit of a pullback at the beginning of the week, the weekly candlestick was still looking to close pretty much in the clear, mostly unchanged from where it had started on Monday. So overall, even though we had seen some reintroduction of volatility at the start of last week, we were looking to end on a kind of more positive or balanced note. Of course, that all went out the window. Throughout the US session, when of course we saw an announcement from Donald Trump essentially to reintroduce tariffs on China, looking to stop about 100% tariffs on Chinese exports starting November 1st, I believe. And that was basically reacting to the news that China had decided to curb exports of rare earth minerals. So to some extent, the move was initiated by China. It's a case now of how much further this is going to be taken. And Kyle, you were just mentioning there how markets seem to be pushing towards a taco trade where this is kind of all played down, kind of in the same way we saw the April 2nd tariffs back then. But yeah, it's interesting to see. I think for me, it's interesting to see how markets reacted to this because We have been talking about this for a while, right? That markets were primed and ready for a reversal. Given the amount of strong bullish momentum that we've seen over the last few months, it kind of meant markets were kind of behaving as if all the uncertainty over trade policy and tariffs had been resolved. Clearly, we hadn't yet had a finite resolution, even though we've had agreements with the European Union, with Japan, with Korea. There was still a lot of loose ends to tie up, China being one of them. But markets had been behaving as if all of that uncertainty had fizzled out. Clearly, by the reaction that we saw on Friday, it was yeah. Clearly, markets really truly believed that it was over, and I think that was what really caught them on the wrong side of this. Because I don't think that this tit for tat is something unexpected. I think you could have seen it was building up to it. But markets were clearly caught off guard, even though today they are trying to undo some of that pullback.
Yeah, and I've just, for the sake of illustrating our points, the tweet that was sent yesterday that seems to have sparked some sort of a relief rally in US futures in particular, but we've also seen a lot of Asian equities off the lows of the session. We've also seen, say, the Aussie dollar, which dropped, to sort of 64.5 cents back to around 65.2 US cents. That's a good barometer of global growth expectations and sentiment towards China and what have you. But I think markets were really sort of obviously put off guard by the fact that the level of tariffs threatened by the Trump administration is big again. It's sort of 100% or so. That came right at the end of the session, actually. So if anyone was trading and, maybe checked their phone at whatever hour and then, went back to it 2 hours later or whatever it happened to be and saw a real dive lower, it was after the 100% threat came through. Before that, it was just, some hot rhetoric about walking away from talks from China and, just Trump's being generally disgruntled about what China did. And there, there is kind of a rationale there as to why Trump would be aggravated, the US would be aggravated, and why this is a sensitive sticking point, because it was in April when the Chinese threatened to curb all rare earth exports to the United States that the US eventually backed down, and that kind of was the kind of escalate to de-escalate move from the Chinese to kind of put the situation back on a far more even keel. So the question is kind of why do they do this now? And what's the motive? Because this is kind of a part of their arsenal, this kind of nuclear option of stopping the flow of these commodities into the United States and all but seizing up fairly significant parts of the US economy, especially parts of the US economy that are very, very strong and strategically important as well, driving growth, more broadly speaking. My best assumption is, like you sort of alluded to, Danny, to get both sides back to the table and focused on getting some kind of a result out of these negotiations, which have kind of stalled. And like you said, Danny, investors have kind of forgotten about that part of the narrative and just let things float on by. The other interesting thing that I did read this week, and there's a lot of obviously speculation that happens in these situations, is that China was really hoping that the fentanyl tariff would be dropped because of what they see as progress on stopping the flow of fentanyl from China into the United States. And they think that this might be a way to achieve that and bring that kind of average tariff rate down to something that's close to sort of the low double digits rather than sort of, I think the average tariff rate is still around 50% on China at the moment. Nevertheless, perhaps because Trump doesn't want to get back into a situation that he was experiencing in April, and that because China has played part in the pun, it's kind of Trump card with rare earths, is that there's this conciliatory tone coming through now that is raising hopes that the 100% on November 1st doesn't actually materialize. I think two things for the markets, equities we'll start with. One is that everyone was on the one side of the boat, positioning was stretched, valuations were really, really rich. All the things that we've talked about for a little while, which means that the markets were a bit complacent and prone just to a little nasty surprise, and it didn't even have to be a necessarily very large one. But for market participants, and as far as the real economy goes, if we end up even in a similar situation to what we did at the, say, end of March and start of April, that had impacts on on the real economy because of decisions not to employ, decisions not to invest, doubts about obviously uh, the value of things that companies were importing and all of those sorts of things. And that had a negative impact on growth. In fact, obviously, we saw, at least on the surface level, a contraction in Q2 growth in the United States, I believe. So the markets have to discount that in some respects. That's probably in the price now. Again, the question is this over and this is just a blip? Or is this something that could be another protracted period of volatility? And it all basically depends if the 100% tariffs, at least in rhetoric, are still on the table.
Yeah, I think one of the questions that people have asked themselves so much since Friday is why has China done this? What is it trying to do with this? And I think for me, it seems a bit more of a negotiation tactic. I think it's an attempt to get the US and China back on the table, focusing not only on lower tariffs, but also on export controls. Because we have to remember the US has had semiconductor restrictions to China. And this rare earth minerals restriction seems like a play on that, and the semiconductor industry relies on rare earths, so it seems to me very much like it's all in the same boat, and it seems like just a way, I guess, to, as I said, to get to the table, talk about export controls, potentially talk about China investing in the US and the limits around that. So I think it's using its rare earth industry as a leverage to get to that point. Whether that's going to be the case or not, I think that's where the importance lies for market, as you were saying, Carl. It's now a case of this has been the initial, I guess, attack or blow.
Got a bow, right? Yeah.
Yeah, so how do we progress from there? Does it actually get worse, and do we see those tariffs actually implemented, or is this again just a negotiation tactic for both sides to kind of consider and reevaluate their positions? As we said, we've been talking about this for a while. Markets were very complacent. There were clear signs of a market that was overstretched and kind of running on just, I guess, in a way, just the momentum that had been building over time, and markets were just really positive towards developments. Earnings have been holding up, so therefore valuations to some extent were being backed by that, the earnings growth. But yeah, it seems like a pretty much a classic reaction of, to some bad news being taken further than necessary. That's why we're seeing the correction this morning. Again, as you said, it doesn't help that also we're still in that US blackout period with data when it comes to the US government shutdown. We're nearing closer towards the end of the month, which is when we have the FOMC decision. We still don't know how the jobs market has evolved, how CPI data, we only have those private readings, and if we're going on what we've seen so far, it isn't great. So I guess it just adds another layer of uncertainty, but markets seem to be pushing through it pretty well.
Yeah, well, I mean, this is what we're sort of looking at as far as the open this morning, and looks like we might retrace about half of the move from Friday night. Maybe we'll just quickly take a glance at just all the moves in the markets that did happen off the back of that very volatile session, because as you can see here, arguably bouncing around 6,500 for the S&P. The Nasdaq had a fairly similar level as well, where it found a bit of support right at the end of the session, or at least these are basically the futures markets right at the end of the session. Whoops, this isn't it. Before, more or less this kind of retracement, and that's actually even more significant move than what I was watching during the Asian session. So we're getting this kind of momentum now coming back into US futures. Again, this kind of bounce off 2,400 or 24,000 or thereabouts for the Nasdaq. Maybe we'll start before, maybe if we before we just go into the rate stuff and the quick chat about earnings. Shall we talk about the gold and
Yeah.
oil element of things, just because we've got gold at record highs right now, and this is one thing that hasn't seemingly reversed the move from Friday night. In fact, it's kept running. And there is the sense that, one, we got a bit of a pullback after record highs last week. Some of that was due to what's developed in the Middle East. And, what obviously from a humanitarian point of view was a very positive development. But there is this sense that even if we get a return to kind of the status quo between the US and China, which is to say some kind of strategic tension, ongoing negotiations, but no further tariffs, export curbs are not implemented, there is still this clear decoupling going on between the US and China. that has geopolitical ramifications, but then also ramifications for, say, what the PBOC continues to do with its FX reserves, which is buy more gold. And investors seem, to my mind, buying into that narrative and ignoring the, oh, it might be not so bad after all narrative.
Yeah, I mean, the performance we've seen of gold in the last few weeks specifically, but I think throughout the year, pretty much alongside the strength that we've seen in equity, really calls to the fact that gold has become, to some extent, a better hedge even than treasuries. When it comes to diversifying portfolios, we've seen that strong performance. We did see a wobble at the beginning of last week, as you said, mostly on the back of that news about a ceasefire between Hamas and Israel. Of course, seeing a little bit of risk coming out of the market and therefore weighing on gold. But it was a technical correction at best. We saw the momentum correct easily on the following day, and we've seen that momentum build higher. Again, I think we've come to a point now where investors are potentially a little bit more cautious with how much follow through this can have before we see a meaningful correction. But nonetheless, the momentum remains there. And even as we see stock markets correcting a little bit this morning, seeing that momentum come through once again, gold continues to push to new highs, again, speaking and alluding to the strength in the commodity and the long-term fundamental, which we've been talking about for quite a while. But interestingly enough, we also have silver pushing once again to significant highs above that $50 mark once again, even as that pullback deepened last week also, because we know that silver has that dual mandate. It is a little bit more sensitive to economic headlines because of its industrial application. And in some of these industries, the tech industries as well. So the strength today in silver, once again, reigniting that move of it's also good as a hedge, but we're now seeing that positive momentum coming through into silver. So I think it really alludes to the strength of precious metals as investors look for other ways to maybe diversify their portfolios, but still remaining somewhat exposed to how the economy and the stock market performs.
Yeah, there's been some interesting dynamics in the silver market too over the last couple of trading days where liquidity has been a little bit problematic, and especially in the open of Asian trade, a lot of dealers are not sort of willing to sort of put out prices, and that's sort of frozen things up a little bit. And I think, if I'm not mistaken, there's a fairly significant contango going on in the futures curve at the moment, really suggestive of this kind of squeeze that's going on in the market and might be partially responsible for pushing prices to the levels that we're seeing now. On the flip side of that, there are a lot of cynics out there, and when it comes to really the like almost atomic detail, quite literally the atomic detail of the commodity, that's where well, I get lost a long time before you get to that point. But there's a lot of interesting comments out there about to what extent silver really should be valued at these levels because of its precious metal quality, as well as its industrial applications too. And that although there are both of those things, that this move has been kind of over-egged and that maybe the narrative is a little bit too strong. But nevertheless, you sort of trust the tape on this one, and there's clearly a very strong demand for silver at the moment, as you can see as we push to record highs. Danny, before we just again jump across just to maybe look at the rates curve, a little bit of a chat about earnings, and then obviously a Q&A if there happens to be any. Oil was a huge mover on Friday night, and you don't have to be obviously Einstein or perhaps, Warren Buffett or Paul Tudor Jones or something like that to understand that tariffs are bad for growth and bad growth is bad for oil. But we have seen a little bit of a retracement, but this kind of continues to feed that story that we've been talking about for a while, that with supply being so well supported, yes, we had OPEC meet a couple of weekends ago and increase output or flag an increase in output in November that wasn't as big as expected. But you've got a sluggish global economy, downside risks, it would appear to it, an environment where that glut is building and may not be absorbed. And lo and behold, you got a move in oil prices that last week did break, or the week before break through what for me was a fairly significant level around 61.50, and then push straight through 60 as well into now a five handle, which is a place we haven't been since the last little meltdown from tariff fears and what have you. So My bias continues to be, notwithstanding probably a bounce that we'll get, and maybe a retest of previous support and our resistance, a market that is trending to the downside.
Yeah, I think we were waiting for this break for a while now because we had been in kind of this sideways consolidation since mid-August, where we'd seen that downside well supported, but also the technicals were pointing towards that bearish momentum building. Those RSIs, the RSI, the moving averages were all kind of pointing to the downside. So we were expecting at some point to break lower, and I think Friday's data was just the perfect catalyst. Sorry, Friday's news was just the perfect catalyst for that to happen. It's now a question of do we make it all the way down to that $55 support area, which, as you said, kind of restricted the move lower back in May. And from a fundamental perspective, as you said, the supply side remains pretty stable in the fact that there doesn't seem to be any reason to assume that there are going to be any supply constraints in the near future, the way things have been moving, and with OPEC once again supplying the market. So it's now a case of the demand side dynamics. And of course, with concerns about growth stemming from this resurgence in tariffs, then I think, yeah, you're looking potentially of that downside to build a little bit longer unless we see a clean, rapid resolution to these fears.
Yeah, I really see at this point in time that it's, either a two-way solution. Either somehow demand picks up fairly significantly, and maybe it's through US rate cuts and expansionary policy that happens. But really it has to be probably a bit more broad based than that. And a pickup in industrial activity in China as well. Or OPEC starts to think, oh, we don't want prices this low. Let's wind back some of these output hikes until one or the other. And I tend to think that the latter is a little bit more likely. As we sort of zoomed out before, this trend in oil seems to be pretty clear to the downside and may well persist into the new year. But let's maybe just touch on what we have in the week ahead as far as, I guess, data, maybe frame it just around, just these rate expectations from the Fed. I'll just flash them up on the screen there. But we're still sort of flying blind because the US shutdown is not looking much closer to being resolved. Trump's going to be in the Middle East for the next couple of days. So if there's any chance that he's able to sort of broker a deal somehow with his counterparts in Congress, is heavily diminished by that. But there's a little bit of Fed speak, and that might be able to inform a little bit just as far as what expectations might be. Not so much for the October decision, because as you can see there, 96% implied probability, that's pretty chunky. But maybe, questions about where the rates trough out going into 2026, especially given that we haven't got data. There's the expectation that maybe we'll get the CPI figures before the end of the month. The BLS, I believe it's the BLS, have called back employees to basically get this data ready for publication before the end of the month. But we're really looking for any kind of clue, private data, Fed speak, Powell speaking this week as well. Some I think introductory remarks. I'll have to double check. But there's a lot of dovishness priced in without sort of much data recently to be able to kind of reaffirm that view.
Yeah, I think markets are still going on where they were before the shutdown, and that was that more rates are coming. I think we have seen some commentary from FOMC members on both sides of the spectrum. I think no one's heavily dovish, no one's heavily hawkish, but I think we have seen some commentary about caution, making sure that the cutting cycle doesn't get too ahead of itself in order to make sure that inflation is contained on the way down, but also on the side of there is still space to lower rates and to make monetary policy more accommodative to be able to adapt to evolving economic conditions and specifically weaker growth. So I think the spectrum lies pretty much balanced on that. So markets are still invested on further rate cuts coming. And of course, the only data that we've had pretty much since the shutdown is that ADP data that we were talking about last week. And that did come in significantly lower than expected, therefore suggesting that the future of the official data is to expect fewer job additions as well. And of course, we'll have to wait until we actually get confirmation from the official data, whether that happens before the meeting or not on October 29th. But I think markets have no reason to expect the Fed to be less dovish, even though we did see a little bit of disappointment from the latest meeting that we saw in September. So, as you said, there's not much really to go on. It's just a case of watching market pricing, whether that changes or not throughout the next few weeks on the back of any private data we may have. We have speakers. I think we have Jerome Powell actually speaking later today. Whether he can provide any hints, I think he's unlikely to do so, considering, how much uncertainty there is about the data, not only markets, but he himself. But yeah, markets may be reactive to any sort of news that comes through the wires, whether there's any further hinting as to what can happen, not only at the meeting at the end of this month, which, as we've already said, seems pretty much like a done deal, but what happens in the next 6 months and where's that terminal rate going to be? Is it higher? Is it lower than markets are expecting?
Indeed. And yeah, like you said, it will be this evening that we get this speech. So he'll be interviewed at the National Association for Business Economics. It's the annual meeting. So
He seems to
keep an
be
eye out.
avoiding any commentary, which is normal. As I said, it's not only us flying in the dark, so is he. But you never know. We may get some kind of snippet that induces some sort of market volatility at this point. I guess we'll see.
We'll see indeed. Before we go to questions, just a quick look at just what the markets are expecting as far as earnings growth for the quarter. We get the banks starting to kick things off fairly soon. I find the banks fairly sort of boring. Mostly our clients don't trade them that much, I think it's fair to say, overall. But you do look for things like credit growth, arrears, and provisions, as well as just the broader profitability. A profitable bank tends to indicate a fairly strong economy, depending on whether the revenues are being generated from. But when you do look at the S&P 500 or analyst expectations for S&P 500 earnings for Q3, it's about 8% at the moment, revised higher from a few weeks ago at 7.9%. So that's basically the bar from here. Again, I've said it in the past, the FactSet pack that comes out once a week on a Friday is really good to follow that. Maybe we'll unpack it a little bit more. I don't know if, obviously Magnificent Seven stocks are what everyone's going to be watching. Those are where the earnings revisions are coming from. As you can see here, partially where a lot of the strength is expected to come from in terms of earnings growth, those tech names. But I don't know if you've got anything to add there, Danny. It's probably one to pick up next week.
Yeah. Yeah, as I said, we start off with banks, not the most exciting. I guess it's just a case of watching those valuations, specifically price to earnings ratios have been a key area of focus. As you said, when we're expecting earnings growth to be in the region of about 7 or 8% for the quarter, it kind of justifies to some extent the moves that we've seen in the stock market recently. And that's why so much kind of pushback on calling this market situation a bubble, because a bubble is usually when the price is kind of very far away from where fundamentals are. But clearly, with the way earnings have been going, and if this quarter also substantiates that, then I think, prices remain, even though they are expensive, they remain supported to some extent. I think that's likely going to be a key focus this earnings season, is making sure that price to earnings remain pretty stable within the range, and that making sure that prices are not actually getting too far ahead of themselves with revised and earnings guidance coming in this season.
Yeah, and I'll just see if I can find anything on Magnificent Seven earnings. No, nothing yet. FactSet often includes an aggregated earnings estimate for Magnificent Seven, but they haven't done it just yet. But as we were seeing sort of just before in that chart, yeah, lofty valuations. It's an interesting comment that I heard the other day, and I think this, really does resonate well, that, if there perhaps is a bubble here, that maybe it's not so much a financial bubble because of the earnings growth that some of these companies are achieving, but there is, the potential for an industrial bubble where a lot of resources could be misallocated if if artificial intelligence technology doesn't really deliver the return on investment that everyone's sort of hoping for, or sort of doesn't deliver sort of the advances and the sort of incredible capabilities that everyone's sort of conjuring up in their imaginations. That's about a minute till 7:30. Let's perhaps just take a quick look at whether we've got any questions, and I think we do have at least one. What you taking? Oh, well, I don't know if you want to start with that one, Danny. It seems to be the only question that we have now. Please, anyone, I invite you to add a question to the chat if you've got it, or to the Q&A section. But there is a question on NVIDIA and some of these deals that are going through. I'm happy to start, Danny, if you want to, unless you want to take the lead.
No, I mean, all I was going to say that there's a lot of one of the key topics I've seen in the past few weeks about these deals with OpenAI and NVIDIA and AMD is basically the circularity of it and whether that's a concern. You know, um, how much of these deals is actually going to mean a significant impact to the industry because a lot of the times is these deals are made throughout the supply line. So we're seeing, how do I explain this? I don't know if I'm making sense, but we're seeing a supplier invest in a product that then they're going to develop within their own product. So yeah, one of the key questions is how much of this circularity is actually going to mean that the breadth of the market is actually much tighter and therefore doesn't substantiate the impact on earnings and growth in the future. I don't know if that makes sense. Kind of
Yeah,
where
I mean, sorry. No, I was going just to add that I think, there's been a lot of talk about sort of the circular movement of money here, and I'm not so much that fearful about that, because I don't think actually, if you really look at what, you might see in a Ponzi scheme or something like that, where you talk about the circular movement of money, where it's just basically the same money moving from one to another. What these deals are really set to establish is to invest in things that those businesses think will help them build capacity within the industry over a long period of time. So, for example, if if NVIDIA is giving money to Intel, it's doing so because it is looking for Intel to use its specialization of function to increase their capacity to build more, which will ultimately benefit NVIDIA. The reason for this, like I said, is that this money is going to areas where it can be more appropriately sort of allocated and utilized productively by by companies who can specialize in these things. And then the benefit of that is not just the capacity that is being built into these industries and the prospect of higher profitability and productivity going forward, but there's also a high element of de-risking here. And the reason why a lot of these companies are de-risking is that they're not just de-risking from a single company. So, for example, I think it's with OpenAI, with NVIDIA and AMD chips, off the top of my head, basically having multiple chip designers on the books, but also de-risking geographically from Taiwan and things that could at some point in time be a risk to supply chains and therefore the health of their businesses. So I think there is a degree of over-eggedness of this concern about circularity, but in my opinion. But what I would say is that it goes back to that point is that there's all of this capacity being built within the industry that if it proves to be the case that there's not much return on investment here and there's been a huge misallocation of resources, that is going to be incredibly costly and that would have to eventually be reflected in stock prices. So that's my view on that one. But for now, you sort of follow in the very short term, just these companies' ability to continue to deliver earnings and monetize the technology, and they have been able to exceed whatever expectations have been put forward for them. So that's the short term concern, really. Um, I think there's an interesting question here about that I'm having trouble deciphering a little bit, but I don't know if I've got much of a view on that, Danny, at all. If you've got one. Um,
about let me see.
might be a reference to an ETF. I might need some sort of clarity there as to what.
Yeah. Yeah, I
Um,
think that's a specific ETF, just to, and also, I guess to some extent also cryptos, which interestingly enough, we don't talk about cryptos a lot, but they did see one of the biggest sell-offs, I think, since
I think it
in a
was
few
almost in
months.
history. It's
Yeah,
almost as far as the value lost, just because of how obviously big the market's got. It was one of
yeah.
the significant drawdowns in history.
Yeah. So we saw a significant pullback in cryptos as well, which to some extent have also been used as a source of leverage alongside gold in recent weeks. I think that correction sparked a little bit of concern in the market, but yeah, we'll just have to see where cryptos goes on the back of that. I think that's pretty much it from our side, Kyle.
Yeah, we're
Um,
5 minutes overdue, so we've given free analysis, so to speak. But anyway, we'll wrap things up for another week. Hopefully, there's a little bit of the Goldilocks spot for volatility. Not too much, not not too little, but might provide some opportunities out there for traders. Obviously, as always, you got to manage your risk carefully in these situations and what have you, but it should provide a sort of fairly ample environment for discussion, if nothing else. But please, we do upload this webinar onto YouTube afterwards. If you would like to watch it back and ideally share it, that would be wonderful. Invite your friends and what have you. But otherwise, Danny, I think that might be us for the week, unless you have anything to add.
No, that's it. Just keep an eye out, as I said, for any headlines, any progress on the talks between China and the US, and of course to see if the government shutdown ends sometime soon, although the hopes aren't very high at this point.
Yeah, keep Truth Social open. Something might come through there that can change the world. So anyway, see you next week, Danny
Have a
and
good
everyone.
one.
Cheers, bye.
Bye.